Hello, dear children. Now, in this video, we will discuss about the banks. Okay, uh, the two types of banks, that is, commercial bank and central bank. Whereas this topic regarding banks, you have already covered in the subject called commerce. There, you will see the various types of banks known as commercial bank, central bank, developmental bank, rural banks. Okay, so first of all, let us have a look at the definition of bank. What is bank? By bank, we mean an institution, okay, a financial institution which accepts the deposits from the public, okay, and the same deposit can be withdrawn as per the demand of the public, okay, and it also provides the loans, and it also provides agency services and other various types of services. So basically, an institution which accepts the deposits, okay, provides you the loan and provides you other types of services, including agency services, okay, custodian services, etc. So that institution is known as the banks, okay. And the banks, as per this topic, we have two types of banks known as the commercial bank and the central bank. Okay, we don't have to go in depth about the definition, by the way. Okay. So let us start with the function directly. So what are the functions of commercial banks? Now, normally and the generally, whatever the banks that we have seen around, okay, like in our Kalimpong town, we have State Bank of India, we have Axis Bank, okay, we have Indian Overseas Bank. So these banks are basically your commercial banks. Okay, so what are the functions of these commercial banks? Number one, acceptance of deposits. Yes, if you go to a bank, okay, open an account and you want to deposit your money into the bank, so the bank will accept the deposits, okay, and also it provides you the loans, okay. Number two, advancing of loans, okay, and number three, facilitation of payments through checks. Yes, if you have a bank account, uh, it provides you the facility of checks, okay, and through the checks you can make the payments as well as receive the payments, okay. Number four, transfer of funds. Nowadays, because of the usage of UPI, you must have noticed that people are transferring the amount of money, okay, from one account to the other account very easily, isn't it? So that is the function of the bank. Like, for example, if you want to transfer the amount of fund uh, from your account to your friend's account, or maybe if you go to Bangalore or Delhi, Kolkata after plus two for the higher studies, then your father or mother will transfer the amount of money into your account. Okay, so that is the function of the transfer of fund. Okay, now agency functions. Now, what do you mean by the agency functions? By agency functions, we mean those type of functions which the bank will do on your behalf. For example, uh, like there is a system of auto debit from your account. For example, if you have to pay EMI of your scooter or EMI of your four-wheeler or of your loan, okay. So if you select the auto payment, so every month on a particular date, the amount of money will be debited, which means the bank will make the payment automatically on your behalf on a particular date. So that is known as the agency functions. Okay, and number six, general utility services. By general utility services, we mean that the bank it provides you the locker facility. Okay, if you want to keep any kind of important document or any kind of important item, okay, which is not safe in your place, so then you can put that safely in the bank's locker. Okay, but however, the bank will charge some amount for providing the locker facility. Okay, and the last one is known as the credit creation. When you go to bank, okay, when you go to bank like this, regarding this particular function, advancing of loans, okay, so the banks, it provides you varieties of loans: personal loan, home loan, car loan, educational loan. Okay, so whenever they are providing you the loans to the public, they don't provide you loan directly into your hand. Okay, they don't provide you loan cash in hand, but they provide you the loan by opening an account. Okay, if you don't have an account, first of all you must open an account, then only the money will be transferred into your account. Okay, but if you are an existing customer, then the amount of money, I mean the loan amount, will be transferred to you into your account. Okay, and uh, there is a process of this credit creation. Okay, however, this credit creation I mean the function, it has been removed, okay, for this particular year. uh, Let me just tell you in brief that if a bank has a deposit, okay, a total deposit of 1000 rupees, uh, now out of that 1000 rupees, bank will keep 200 rupees with itself. Okay, and the remaining amount, okay, 800 will be given to the public as loans. Okay, if they approach, okay, they will keep 20% of it. Okay, out of 1000, 20% will be kept by the bank. Okay, and the remaining amount, it will be given to the public, that is 800. Okay, and again out of 800, they keep remaining 20%, and 640 will be provided to the public. Okay, so this is how they create the uh, credit. Okay, unfortunately this process is missing out here. Okay, so without that process, this topic credit creation is not possible for us to understand. But however, just remember this, that the commercial banks, they have the power of credit creation. Okay, it is their one of the function of the commercial bank. Okay, that's it. You don't have to go in depth and in the process. Okay, now this kind of see this acceptance of deposits. So what are the types of the deposits? The types of the deposits are current account deposits, saving account deposits, fixed deposit account, and the recurring deposit account. We are already familiar with these terms. Okay, let us just understand in brief. By current account, we mean such type of account uh, which uh, which has no transaction limit. Okay, which has no transaction limit, and whenever the amount sorry, whenever the amount should be, yeah, whenever the customers, whenever the customers, they want to withdraw the amount, okay, at any point of time they can withdraw the amount. So these kind of deposits are known as the demand deposits. Okay, and basically, this current account deposits are generally opened by the business persons because they have so many transactions to deal with in a particular day. Okay, so they open such kind of current account, and in some current accounts they also have the credit facility. Okay, that is why you must have noticed in accounting that there is a bank overdraft which appears towards the liability side of the balance sheet. So you can observe the negative bank balance. So the current account, they also provide the overdraft facility. Okay, so basically this account is opened by the business persons. Okay, there is no such kind of restriction regarding the amount of deposit, I mean the number of deposits and the withdrawals. Okay, now, saving account. Now, saving account is generally opened by the normal customers, just like us, you and me. Okay, and in saving account, you don't have the facility of overdraft. Okay, and In saving this saving account, there is a transaction. Okay, there is a transaction of sorry, there is a restriction of transactions. Okay, there is a limit. Okay, uh, uh, like you cannot withdraw more than 60,000 or 1 lakh in a day. Okay, if you withdraw more than that, then it will show that you have reached the maximum limit for a day. Again, if you want to withdraw the money, then you have to try the next day. Okay, unlike in current account, you can pull out the money anytime. Okay, but in the saving account, that kind of restriction can be observed. Okay, now the fixed deposit account. Now fixed deposit account is a type of an account which a person opens, and a certain amount of money is kept for a certain period of time. Let us say that if you want to open a fixed deposit account, okay, or simply FD account, and uh, you put 1,000 rupees for the next 2 years, which means for the next 2 years you cannot withdraw the money. Okay, that is why this type of deposit are also known as the term deposit account. Okay, and the recurring deposit account. In recurring deposit account, what happens is that the customers, they deposit a fixed amount of money, let us say 1,000 rupees, okay, every month for a certain period of time. Let us say you open an account, okay, RD account for the next 2 years, okay, and every month you will deposit, okay, for the next 24 months you will deposit 1,000, okay, each month, okay, and when the maturity period will be over, you will receive your money in your account. Okay, it's very simple. And regarding this loans, regarding this loans, we have this cash credit, okay, outright loans and advances, okay, overdraft facilities, and number 4, discounting bills of exchange. So number 1, cash credit. uh, Cash credit. So what do you mean by the cash credit? By cash credit, we mean a type of a credit or a loan which is given by the bank, okay, against the current assets. So what can be the current assets? It can be your market shares, okay, bonds, stock of goods, etc. So this kind of loan, whenever they are provided mm, to the public against our current assets, then it is known as the cash credit. Okay, now this cash credit, it has a certain amount of limit. Okay, let us say 20,000. Okay, your current account, it values for rupees 20,000, so they will give you a cash limit of 20,000, but you just utilized 10,000 rupees out of the total limit. Okay, now only on that withdrawn amount, that is 10,000 rupees, the interest will be charged. Okay, whatever the unutilized amount is there, the bank will not charge interest on that part. Okay, number 2, outright loans and advances. Now this kind of loans are actually provided for a fixed period of time. Okay, and it can be for a short period as well as for the long term period. Okay, and in this case, the entire money, okay, whatever the entire money whatever the amount of loan that has been given, okay, the entire money, it will be transferred to the uh, customer's account. For example, uh, personal loan, okay, like uh, last year, maybe last year, I think, yeah, I had taken this personal loan account. Okay, I had just tried it. Now the amount was it was a very small amount. Okay, only 50,000. Okay, so I had tried this. Okay, let us just take it because the bank is providing me. Now this 50,000, now the entire money 50,000 was transferred into my account. Okay, so this is known as the outright loans. Okay, and remember, the borrower in this particular case in outright loans, okay, the borrower has to take has to pay and the interest on the entire amount, that is 50,000. Okay, I have to pay the interest on 50,000 only. Okay, but in the case of the cash credit, whatever the borrower, okay, whatever the customer is using out of the total credit limit, okay, whatever the money will be withdrawn by the customer, only on that part the interest will be charged. So this is the only difference between the cash credit and the outright loans and advances. Okay, now overdraft facilities. uh, Usually, as I've already discussed here, that in case of the current account deposits, the this overdraft facilities are provided. Okay, because sometimes the business person, okay, they may not have a minimum amount to um, enter into a business transaction. Okay, at a particular point of time. Let us say the amount is 1 lakh. Okay, the transaction cost is rupees 1 lakh, but he has only 75,000. So the bank will provide overdraft facility of 25,000 for a time being. Okay, or maybe on the closing date the overdraft was showing to be 25,000. So this 25,000, it will appear towards the liability side of the balance sheet. Okay, so whenever the customer will deposit the amount, automatically this overdraft will be deducted. Okay, this overdraft will be it will be rectified. Okay, it will be adjusted as the customer deposit the money into the account. Now, number 4, discounting bills of exchange. We have already observed this in class 11 also. You must have done this in the chapter bills of exchange. Okay, so the banks, they provide the facility of discounting the bills of exchange in the banks. Okay, like for example, if a bill is drawn for 3 months, okay, and the drawer, you are the drawer, okay, and I am a drawee. So you as a drawer, you need money uh, just after 1 month. Okay, so after a month you can take the bill to the bank and that bill, it will be discounted. Okay, because as per the negotiable instrument act, bills of exchange is regarded as a negotiable instrument, just like um, the bank checks. Okay, now what do you mean by the central bank? By central bank we mean the apex body in the banking and the financial structure of the country. Okay, we, we mean the apex body, that is the main central body. Okay, that is the spinal cord of the banking and the financial structure of the country. Okay, and it is also known as the bankers bank. Okay, it is known as the bankers bank because it controls all the banks across the country. Okay, and it is also known as the banker to the government. Okay, or banker of the government, because the government, they deposit money to the bank, I mean the central bank, and whenever the governments, they want loan, central bank provides the loan to the government. Okay, and it should be remembered that Reserve Bank of India is the central bank of India, which was established on 1st of April 1935, and we already know this, that RBI is the central bank of India. Okay, and remember there is one more bank that is known as the central bank of, central bank. Remember, central bank, that bank which we're talking about, okay, that is not the central bank. Okay, only the name is central bank. Okay, remember, so don't get confused with that. RBI is the central bank of India, and we already know this. So what are the functions of the central bank? Now, number 1, bank of issue. Number 2, banker. Okay, fiscal agent, and okay, let us discuss them one by one. Number 1, bank of issue. It is a bank where the currency notes and the coins are issued. Okay, so this bank, central bank, it has the authority to issue the currency notes and the coins. So thus it is known as the bank of issue. Okay. Now point number two, a banker, fiscal agent, and advisor to the government. Yes, central bank, it acts like a banker to the government. Okay, because the government, they can deposit their money into the uh, central bank. Okay, and they can also take loan from the central bank. Okay, so thus they are known as the banker to the government. Okay, and fiscal agent, yes, they they regulate the tax. Okay, they help in the taxation policy. Okay, whatever the government, they come up with their policies. Okay, ultimately the reserve bank, they play the vital role for regulating the uh, fiscal policies. Okay, along with the Ministry of Finance, RBI, it plays a very important role in controlling and regulating the financial policies across the country. Okay, so thus they are known as the fiscal agent. Remember, this term fiscal is associated with the taxation policy. Okay, we will see afterwards what is fiscal policy and the monetary policy. We will discuss. Advisor to the government. Yes, central bank, it also provides advice to the government. Okay, that what should be the uh, what should be the foreign exchange reserve. Okay, whether the whether how to control inflation or deflation in the market. Okay, if your economy is uh, crunching down. Okay, what steps can should be taken to revive the economy. Okay, so central bank, it also acts as the advisor. Okay, as a guide to the government. Banker to the banks. Yes, central bank, it uh, it acts like a banker to the banks, because whatever the banks, okay, this be it a commercial bank, be it rural banks, okay, be it developmental banks, okay, be it agricultural banks. So there are varieties of banks in the country, isn't it? So let us just take a commercial bank for an instance. So whatever the commercial banks, they deposit, they accept the deposits. They ultimately have to report to the central bank that this is our deposit. Okay, and we are depositing this much of money with you. So whatever the central bank, it guides. Okay, this should be the interest rate. Okay, this should be the repo rate, this should be the reverse repo rate. So whatever the central bank, it give, gives you the guideline. Okay, the banks across the country, they must follow the same. Okay, so thus it is known as the banker to the banks. Okay, and point number four, custodian of nations foreign exchange reserves. Yes, we have already discussed what is foreign exchange reserve. Okay, so it is the custodian of nations foreign exchange reserve. Ultimately, like even this commercial banks, they hold some amount of foreign exchange reserve. Okay, that is actually your exim bank. Okay, for example, now this kind of banks, ultimately they deposit the foreign exchange reserve into the central bank. So they are the custodian of the nation's foreign exchange reserve. And point number five, lender of the last resort. What does it mean? If a commercial bank is not providing you a loan, let us assume that way, you will approach the different bank, isn't it? And even if that bank is not providing you the loan, so then ultimately you can go to the central bank and apply for the loan. If no commercial banks are providing you the loan, then you can approach central bank. Now, this clearing house for transfer and settlement of mutual claims of commercial banks. Basically, this clearing house function is regarding the checks. Okay, For example, you may have Axis Bank account and I have SBI account. Okay. Now, if you pay me through Axis Bank account check, okay, and I have the account with SBI. So that particular check, first of all, it will go to the clearing house, okay, and from clearing house, this a message will be sent to the RBI. Okay, they have the regional office. By the way, I don't know where it is in Kalimpong, but there is this clearing house in Subhaspalli area. Okay, in Siliguri. I'm talking about the Siliguri. Okay, I don't know where is the clearing house in Kalimpong, but there is a clearing house in Siliguri. So the clearing house, it will give I mean the from the clearing house, okay, like clearing house is a kind of an place where all the checks it goes out there. Okay, whatever the checks that we deposit into the bank will actually take that check into the clearing house first. Okay, and from the clearing house the checks will get cleared. Okay, because from the clearing house the message or the notification will be sent to the RBI. Okay, they will go through. Okay, and the money it will be ultimately transferred to the um, different bank account. Okay, this clearing house is needed when when a when a when an account holder of different bank, let us say when an account holder of Axis Bank is paying to the account holder of SBI or a different bank through the check of through the check of Axis Bank. Okay, so if you are paying me by Axis Bank check and I don't have Axis Bank account, but I have SBI account, so then uh, it is actually here you can basically see the transaction between the two banks. Okay, Axis Bank and SBI Bank, isn't it? Sorry, Axis Bank and SBI. So uh, the check of Axis Bank, it should get cleared. It should get the green signal that the money it should be credited into my account and the money should be debited from your account. So this clearing house function, I mean this authority, uh, I mean to clear this transaction, central bank it has got the authority. Okay, so that is why it is known as the clearing house function. Okay, in a very simple language. Now number 7, controller of this credit. Now uh, the the central bank uh, it has the one of the major uh, role to play in the credit control. Okay, if the inflation is increasing in the market, now what the banks will do is that they will increase the bank rates. Okay, they will increase the bank rates, that is they will increase the uh, interest rates on the loans. Okay, so the money supply it should be cut down, because if more and more money is supplied in the market, what happens? The inflation it keeps on rising. Okay, and even they will increase the repo rate. Okay, because we will see what is repo rate and reverse repo rate. Okay, how? Okay, let us discuss this point afterwards. Okay, controller of credit. Just remember that this credit control is one of the function of a central bank. Okay, we'll discuss this point. Now, promotional and developmental functions. Yes. Uh, Now, the central bank, uh, they can promote a very strong banking system. Okay, uh, and for this purpose, they can provide the liberal and cheap rediscounting facilities in commercial banks and gives various types of concessions. in a very simple language, to promote the banking system in the country, what the central bank it can do is that it can provide the concessions. Okay, they can cut down the repo rates. Okay, they can provide the um, discounting facilities as well as the rediscounting facilities. Okay, uh, and they also uh, promote the development through the developmental banks. Okay, and the main motive of the developmental banks is for the development of the economy. Uh, in the micro sector, you can say that it is about the development of agriculture, okay, industry and MSMEs, okay, and other various types of sectors. That is why you must have noticed, I think you must have noticed that uh, if you want to have this startup, okay, if you want to initiate this concept of startup, the banks will provide you loan at a very this uh, low rates. Okay, the banks will provide you the loans at the low interest rates if you want to start a startup. Okay, if you want to start a new business. Okay, so it is one of the promotional and the developmental functions. And number 9, publications of economic and statistical information. Yes, the you can visit the official website of RBI. Okay, regularly. Okay, monthly or quarterly or half yearly, annually they do it, of course. Okay, they keep on publishing the important economic and statistical information. Okay, for example, what is the current CRR rate? What is the current SLR rate? What is the current repo rate? Okay, what is the current inflation rate? Okay, if you want this kind of information, you can directly visit the website of RBI. Okay, yeah, regarding this credit control, there is a picture given in your book. I mean this flow chart. Okay, you can go through this. It's in the page number 258. Okay, this methods of credit control. Now there are two types of methods. One is known as the quantitative method. Okay, the other one is known as qualitative methods. Okay, qualitative instruments, you can basically say. Okay, so what are the quantitative instruments? Number one, bank rate, okay, open market operations, and cash reserve ratio. Okay, so this qualitative instruments: consumer credit regulations, margin requirements, credit rationing, direct actions, moral suasion, and publicity. So let us discuss them one by one. Now, as I have already said that this uh, the function credit control, okay, this credit control function is associated with regarding the monetary policy. Okay, whatever the taxation policies are there, it is this fiscal, okay, this term fiscal is associated with the taxation policy. Okay, whenever um, the term you come across fiscal policy, remember that the policy is associated to the taxation. Okay, but whenever you see this uh, credit control, it is associated to the monetary policy. Now, what is the monetary policy? It is the policy of the central bank to control and regulate the availability and flow of credit with the public, as well as the cost and use of money for achieving certain predetermined objectives of economic policy. Okay, so regarding this monetary policy, okay, using this monetary policy, the central bank they can control and regulate the flow of credit, okay, in the country. Okay, whether to supply more money or less money in the market. Okay, so that is regarding the monetary policy. Okay, now this major portion of money supply and in an economy, it consists of the bank money or the bank credit. Okay, whatever the bank money it's there in the market, basically whatever the money you have in your pocket or whatever the money it's available in the market, that is only known as the bank money. We have seen this already in the high powered money case, right? So be it known as your bank money or the bank credit, this control of the money supply is actually possible through the supply of bank credit only. Okay, if the bank they uh, provide you loans in a very cheaper rate, what happens? Each and everybody will take the loan from bank. But if the banks they are charging high interest rates, then the supply of money it will be cut down. Okay, so that is why this monetary policy is also known as the credit policy. Remember this. Okay, now what are the objectives of monetary policy? The objectives of monetary policy are: number one, economic growth; number two, price stability in the country, okay, uh, to control inflation and deflation, after all. Now number three, attainment of full employment. This attainment of full employment, in this concept, it can be seen from the chapter aggregate demand and supply. Where you will achieve that, like how it can be achieved. Okay, now again regarding this equilibrium in the BOP. Okay, and also the stability in the rate of foreign exchange. Okay, and number six, growth with equity. Now regarding this growth, yeah, these points are already heard. Okay, and we are already familiar with these terms, so I will not go in detail. This economic growth, okay, price stability, attainment of full employment, BOP equilibrium, stability in the rate of foreign exchange. Okay, we are already familiar with this, and this is one of the objective of the monetary policy of any central bank. Now, what is growth with equity? This growth with equity, it means that um, the equal distribution of income should be provided. Okay, but by equal distribution of income, we mean out here that, for example, if there are three persons, A, B, and C, okay, now A is earning 10,000 rupees, okay, whereas B is earning 5,000 rupees and C is earning 3,000 rupees, okay, 10,000, 5,000, and 3,000. Now, who is earning less out here? C is earning less, only 3,000. Okay, A is earning 10,000, B is earning 5,000, and C is earning 3,000. So, who is earning less? C is earning less. So, C should be given more facilities by the central bank. So, this is the concept of the equity. Okay, out here. Remember, growth with equity. That's it. You just have to understand the points. You don't have to go in detail about it. Okay, I'm just explaining you. Anyway, now the quantitative methods. The quantitative methods are three: bank rates, open market operations, and cash reserve ratio. Now, what do you mean by the bank rates? By the bank rates, we normally uh, discuss about the rate at which the central bank gives loans and advances to the commercial banks, okay, or rediscounts the approved bills of exchange and the government securities. Basically, the bank rates are actually the um, interest rates, okay, for the loans that is provided by the commercial bank to the central from sorry by the central bank to the commercial banks, and whatever the uh, rates are being fixed by the commercial banks actually depends on the bank rates, that is the interest charged by the by the central bank. Okay, some banks they provide you the loan at 12%, some bank they provide you the loan at 10.42%. So it varies from bank to the banks. Okay, from one bank to the other bank, the bank rates it varies. So whatever the um, interest rates are available, okay, So that is known as your bank rates. Okay, on what rate the bills of exchange it should be discounted. Okay, so that's known as your bank rate. Okay, if the bank, I mean, if the inflation is increasing in the country and they want to control the inflation, okay, then what they will do, they will increase the bank rates. Okay, so this way the money supply it will be controlled. Okay, and if there is deflation in the market, then they will cut down the bank rate so more money can be supplied in the market. So that's how they keep on regulating the bank rates. Okay, now number two, this open market operations. What do you mean by open market operations? This open market operations are it is a very simple concept. By open market operations, we refer to the sale and purchase of government and other approved securities by central bank in the money and capital markets. Whenever central bank they sell the securities, okay, and the government approved bonds, okay, whenever the central bank they purchase and sell, okay, remember whenever the central bank it purchase and sell government approved securities and the bonds, that is only known as the open market. That is only known as the open market in simple language. Okay, and what is this cash reserve ratio, CRR? This CRR is actually the amount of it is actually the amount of money. Uh, Actually, it is the amount of money of the total deposits with a commercial bank that they must keep with central bank. Okay, the minimum portion. For example, the total deposits of uh, commercial bank is 1000. Okay, and RBI has said that 200 must be deposited with me. Okay, 200 should be deposited in my account. Then then the commercial banks they are bound to, okay, deposit 200 out of 1000 with RBI. So this is known as CRR, okay, cash reserve ratio. Okay, and there is one more ratio that is known as your SLR. Okay, that SLR is actually again the same thing. It is just like SLR only, but that portion of money that they must keep with themselves, okay, to maintain the liquidity. Okay, now the qualitative methods. Number one, regulation of consumer credit. Okay, they will regulate the consumer credit facilities. Okay, like for example, if the customers are buying expensive materials like iPhone and other luxury items like Tesla car, okay, and other various types of expensive items, okay, then the um, uh, then a certain amount of this mm, um, this down payment it must be paid. Okay, like I purchased this scooty. Okay, so I had to pay a certain amount of down payment. Okay, below that I was not allowed to do so. Okay, so I had to pay a certain amount of minimum limit of down payment. So that is about the regulation of the consumer credit. Okay, uh, let us say I deposited 40,000. So the remaining amount of money, around 78,000, 68,000 maybe. Okay, it was paid by the uh, bank. So that is the credit regulation. Okay, now this regulation of margin requirements. Now, you must have noticed or you must have heard about this mortgage loans. Okay, banks, they ask for some kind of security, okay, and against that security the loans are provided to the customers. And normally this securities, let us say, if you if you keep a plot of land as mortgage, okay, and the plot of land, it costs rupees 1 sorry it costs rupees 2 lakh, okay. Now the banks will uh, keep the margin. They will not give you the loan equal to the um, asset value, whatever you have kept as mortgage. So the bank will give you loan for rupees 1,50,000 or 1,70,000 or 1,80,000, but they will not give you the loan amount equal to your asset value. So this is regarding. So this is the qualitative method regarding this regulation of margin requirement. Okay. Now this credit rationing. Now this credit rationing is about mm, it like giving you a maximum slab or a maximum, you can say, a ceiling of the uh, credit creation in some cases, like to limit the amount of loan for a specific kind of purpose. For example, if you want to take loan of like a personal loan, okay, personal loan can be of, it will starts from it starts from 50,000 from bank, okay. Not about this kind of Dhani app or other type of apps they are in the market. So the banks, the minimum amount of personal loan, it starts with 50,000 and it goes up to 1,50,000, or maybe in some cases up to 2 lakh. But if you want to take the personal loan of 10 lakh rupees, is this possible? No, it's not possible. So for a you know for the types of loans, okay, for different types of loans like personal loan, educational loan, home loan, car loan, there is a minimum slab, that is the minimum, that is the floor, okay, and there is a maximum slab or a maximum cap, that is the ceiling, okay. There is a lower limit and a upper limit for different types of loans. That is only known as your credit rationing. This regarding moral suasion. Like it is a method where the bank will pursue or request, and it provides the suggestions to the commercial banks, okay. It provides the message to adopt a kind of a monetary policy as per the situation, okay, as per the market conditions, okay. Because there can be some kind of varicity, okay, from one region to the other region, like this in Kalimpong, the situation, it can be different, okay. The number of the customers, it obviously it will vary, the population size, okay. So depending upon that, okay, depending upon the composition of the population size also, the this moral suasion, it can be pursued, okay. And this publicity is one of the another method of the selective credit control, okay. And I have provided you this definitions out here. What is repo rate? What is reverse repo rate? Open market operations, this cash reserve ratio, SLR, okay. You can go through this. Repo rate. What is the repo rate? It's a very simple concept at which the RBI, it lends money to the commercial banks. Basically, it purchases the bonds from the commercial banks, okay, which means they are providing loan to the commercial banks. And in reverse repo rate, what happens is that they sell those bonds to the commercial banks, okay, that is known as the reverse repo rate. And in open market operations, we mean that the purchase and sale of approved securities and the bonds, it takes place by the central bank in the money market as well as the capital markets. And remember, this money market and capital market also you have covered in the mm, uh, financial market, I think, in commerce. Okay. And regarding this cash reserve ratio, as I've already said, that it is a minimum amount of percentage of the total deposits with the commercial bank which they are required to maintain in the form of cash reserves with the central bank. For example, if the total deposit of uh, commercial bank is 1000, then they must keep 200 as a reserve with the central bank. This is known as your cash reserve ratio. Okay. And what do you mean by statutory liquidity ratio? It is actually the amount of money of the total deposit. Again, let us say 1000, which the commercial bank must keep with themselves to maintain the liquidity. Let us say 150 rupees they must keep with themselves. So out of 1000, now both CRR and SLR must be segregated. Okay, out of 1000, commercial banks are forced to, they are obliged to keep 200 as reserve with RBI and again 150 with them. So total is how much? 200 plus 150, 350. Now remaining amount 650. Yes, now they are free to provide 650 as loans to the public. Okay, so depending upon the situation, okay, in order to control inflation, the central bank, it increases CRR and SLR rates. Okay, if they want to control deflation, they will decrease the CRR and SLR rates. Okay, I have come up with the latest data, that is from as on 3rd May 2022. Bank rate is 4.25%, repo rate is 4.00%, reverse repo rate is 3.35%, CRR is 4%, and SLR is 18%. So since you can see that the data is also provided out here in the page number 262, as you can see that the CRR is same, SLR is 19.5%, but here it is 18%. So what does it mean? It means that when the data it came up 19.5, maybe there was a high rate of inflation in the market. So to control that inflation, government has made this 19.5, that is they had increased the SLR. Okay, now the SLR, the current SLR rate is 18%. Now you may notice that there is already inflation in the market, isn't it? The bank should control this SLR. They should increase the SLR to more than 19.25%. It should be more than 20% or 21%. Who knows? They want to uh, increase the inflation uh, for a time being, and they cannot all of a sudden just manipulate with this SLR, because there are other factors also. Okay, these are just one of the aspect of controlling the credit in the country, okay, to control the inflation in the market. But there are other factors also which can affect your inflation rate in the economy. Okay, so just by increasing or decreasing, you cannot manipulate or control inflation and deflation. It is just one of the measure to control the inflation or deflation in the market. Okay, and these are the functions of the mm, uh, central bank.